Hi, welcome to Retiring Well. Folks, we got a great show lined up for you today. We're going to talk about the hit list, healthcare, inflation, taxes. 7 mistakes you make when you're possibly choosing an advisor, the 4 C's of banking, what is the financial cycle as it relates to business, and then finally, planned giving, some strategies you may want to know about, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, listen, in this segment, I want to talk to you about what we call the hit list, okay? HIT, healthcare, inflation, taxes. Listen, folks, these are probably some of the greater threats to your retirement savings, right? First of all, let's talk about health. You know, we tell people all the time they'd love to be able to spend down their assets, so that by the time they die, they're not leaving a whole lot behind, unless they were legacy minded, right? The only problem with that plan is you have to know when you're going to die, right? But listen, we have to be very careful here not to spend down all our assets and do something like that, because what about later years when we may need it for health care, right? That's typically when we're probably going to see our greater medical costs. We're going to want some lump sum to be there for that care. Long-term care is a growing concern among people. There's very few people that probably don't know somebody that, with a family member, maybe it's a parent, uncle, aunt, grandma, grandpa, that didn't go into long-term care, and they want to know what the plan is for them. There's several things they can do. They can self-insure, get long-term care insurance, but it's something we want to plan for. Listen, inflation, another great threat to our retirement savings. What is it? When you have inflation, you have what's called a loss of purchasing power. So you can set up a plan, and then with growing inflation, if you don't have a plan to account for that, if you lose purchasing power, it can hurt your plan, right? And folks, we're in an environment today with low interest rates. It's becoming very challenging to have that growth keep up with inflation, right? Back in the day when bonds were paying maybe 5-6%, we didn't have an issue. Today, much lower, very much a challenge. If you didn't know it, Social Security has a cost of living adjustment associated with it, and pensions may or may not. That can help, but otherwise, if you don't have that, you're going to want your retirement savings to try to grow and keep up with that. Another threat is taxes. Right? I just want to give you an example, and you can do the math on this if you want. If I took $1, doubled it every 20 years, okay, at the end of 20 years, it would be worth over $1 million. I think it's $1,048,576. Now, I take that same thing, and every year, though, Uncle Sam's going to take 15% of the growth, okay? That's the only variable in there, is every time it doubles, he gets 15%. At the end of 20 years, it's now only worth $220,000. Folks, that's a big difference. That shows you the impact of taxes. What's your IRA exit strategy? Listen, you got a partner in that account, right? How do we get that partner out? You can do that through Roth conversions. Maybe it's even life insurance, and we can show you how you can do that. Any holistic plan out there should address all 3 of these areas: healthcare, inflation, taxes. Why is it so important? Because when you get to the preservation, wealth, and income phase of your life, you don't want these things to creep up on you. Folks, if we can be of any help, give us a call.
What great information, and it's all the more reason out there why so many advisors don't talk about this stuff with you. They want to talk about the investments. Well, folks, these are really important things that we don't hear enough about. It's something you don't want to hear about probably because they're challenging. But for example, that health care, whether you're retiring early or before 65, before you get to Medicare, that's a lot of planning. There's a lot of different options out there for you in the ways that really can impact the longevity of your retirement plan. Then obviously later in life, what does long-term care look like and all those things? How is your retirement plan built to handle that? If you don't know, that could be a big issue down the road.
Yeah, so true, Art. And that's where we have a planning software that we like to use for our clients, where we're able to map out, hey, what does the next 40 plus years of your life look like from a financial perspective? And one of the big things that gets into is the inflation piece, and trying to see, okay, if you're living on, say, $5,000 a month today, what does that look like when you're, say, in your 70s or 80s or 90s, and how much does that grow to? But along with that was just sitting down with a couple, and we were looking at that and talking through that, but then came into play, because they were retiring prior to age 65, what those healthcare expenses look like. And so we were, again, able to run through some scenarios to show them a rough estimate of what the health insurance costs would be. Along with that, then, of course, everybody's favorite comes taxes. And just like Larry talked about, I mean, how big of an impact tax planning can have when it comes to your overall retirement strategy, and making sure that you're drawing income from the appropriate accounts. And so, again, it just comes back together, Art, of why we want to be looking at all these different areas.
Absolutely, John. You know, when we're here on the show, we talk all the time about wanting you to plan to retire well. Well, we really mean that. And when we're putting all these plans together, we're being to have a very holistic approach to that. We're not just focusing on the investments. All the stuff that John talked about, what Larry talked about in the earlier segment, is all stuff that we spend a great deal of time on. So if that's somebody out you, then you're not sure of your plan or don't have one yet, give us a call at the number on the screen. We'd love to sit down, free, no obligations visit to walk through that with you. You're going to want to stay with us, because coming up next, we're going to talk about the 7 mistakes people make when picking a financial advisor.
When does a Roth IRA conversion strategy make sense? Check out our free instant download of the Wealth Report at sen-wealth.com regarding Roth IRA conversions to help you plan to retire well. Find out what the Roth IRA conversion rules are and what scenarios are beneficial from a tax perspective. To receive this instant download, simply visit sen-wealth.com, scroll down, and click Download Now to receive your copy of the Wealth Report. Simply visit sen-wealth.com.
At Centennial Wealth Advisory, we specialize in retirement planning. Folks, we put a show together every week that we talk about a number of financial topics that are critical in your retirement planning, from tax planning, estate planning, income planning, long-term care, health care planning, and investment management. If you missed the show, then you just visit our website, go to the media tab, and you'll see the latest show. Seven mistakes you make when choosing an advisor. Number 1, not picking an advisor that's a fiduciary. Now, a fiduciary is just somebody that has to act in your best interests, okay? Obviously, everybody wants that kind of an advisor, you would think, but not all advisors are fiduciaries, so that's number 1 mistake. Second mistake you make is just hiring the first advisor you see. You know, if you're looking for an advisor, you're looking for somebody that you connect with, that you're going to trust, then I would dare say I would visit more than just one. I would maybe see 1, 2, or let's say 2 or 3 at least, just to get a feel for, you know, the differences with advisors, to pick one that might be a better fit for you. Number 3, choosing one with the wrong specialty. Now, if you go to an advisor that just sells insurance products, what do you think is going to be the answer to all your problems? Insurance, right? If you pick an advisor that's just selling stocks, bonds, mutual funds, what do they think is going to be the answer to all your problems? You guessed it, right? So you're going to want to understand, you know, if it's somebody that's more independent, that can sell a vast array of financial instruments, might be a better fit for you. Number 4, picking an advisor with an incompatible strategy. If you're picking an advisor who works really well with somebody that's in the you know, growth and accumulation phase of their life, they're working and take on a lot more risk, and yet you're somebody getting soon to be retired or retired, that advisor might be incompatible for you, because they're looking at more growth strategies when what you really need is more preservation and wealth. So picking an advisor that's got an incompatible strategy. Number 5, not asking for credentials. That's very important. You know, you see those commercials on certified financial planners and how the guy ended up being a DJ or disc jockey, you know, and they were going to put all their money with this person. You know, what kind of credentials they have, but even most importantly, what kind of experience. Has that person been in the business for quite some time? More likely, if they've been in for 20 years, they've experienced the last 2 market drops, and maybe they're going to be, that experience is going to, you know, help them in making forming a better strategy strategy for you, and also knowing what's out there and what's available. Number 6, not understanding how they get paid. People want to know how people get paid, and it's very important. Are you paying too much? But transparency is a real key to that. Number 7, not getting references. Now, a lot of advisors, they can't give you testimonials. That they're not allowed to do that. They can't post them on websites. But they can get permission from some of their clients to allow their name to be given out for referrals. So sometimes if you just want to see how a person's operating with others, ask for those referrals. And I'll give you a bonus mistake, not calling me. I encourage you, if you're somebody that needs an advisor or just wants a second opinion, call Centennial Wealth.
If you are retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
During a market downturn, people tend to panic. That's a natural reaction to seeing your retirement savings decline right in front of your eyes. Take a deep breath. We can help. We recommend the following 3 steps. Number 1, schedule risk exposure review and make adjustments if necessary. Number 2, request a retirement income analysis to serve as the starting point for your retirement strategy, making sure your money lasts as long as you do. And number 3, develop a holistic financial plan. Call or click to request a free, no obligation meeting, either in person or over the phone or video chat. We look forward to meeting you. Plan to retire well.
What are the 4 C's of banking? Have you ever heard this? Well, let me just walk you through them. The first C of banking is what we call character. I remember a story of my dad telling me when he was in the Coast Guard, and he was overseas or just got back into the States. We had been in Spain for 2 years. He needed a car. And I remember him saying that he was able to call his bank right in Traverse City, Michigan, and they literally was able to get him the funds to get buy that car without any paperwork. When he finally got back here to Traverse City, they finished up the paperwork at the time. They did the loan solely based on my dad's character because they knew who he was, they knew that he was from here, and so they were able to do that loan. The second C of banking is what you call collateral. Collateral. It used to be, the farmer could come into the bank and show you, he'd have his tractor or some equipment that he could put up for collateral, and the bank would just give him a loan based on that and maybe his character, right? But all they had to have was just sufficient collateral to do the loan. The third C of banking is cash flow. What is the ability of that person to pay that loan back? Now, I saw a time there in the banking industry for some time where collateral was not enough. All right, they could have the best of character and they had the best of collateral, but if they couldn't sufficiently show through their financial statements that they had the ability to pay that loan back, and weather maybe even a downturn, then they were not going to get the loan. And then the 4th C in banking is what they call credit. All right, very, very important. Today you have agencies that can rate you. They look at your past payment history. They look at what kind of loans you have out there, how much you're using on the credit card. All kinds of factors in determining and giving you what they call a credit score. Now today I see a lot of banks, loaning, almost entirely on that credit score. What kind of an interest rate you get is going to be based on what that credit score is. So all of these are important. Your character obviously is going to be important. The kind of collateral you're putting up for the loan is going to be important. Cash flow, you better be able to pay it back, right? And have a good credit score.
Again, great information that Larry's sharing there with us, and one of the things that caught my attention is when looking for a financial advisor, I had a recent conversation with someone who'd been with the same institution for a number of years, so they'd really built, I guess, a relationship with the institution, but they said every 2 or 3 years it seems like their financial advisor is changing, that they're moving on to some other location and then somebody new is coming in, so there hasn't been the ability to really build that relationship, which has made it challenging then for them to sort of build that long-term plan, because it seems like things are changing on such a regular basis. And so again, that's one of the things that we find here at Centennial Wealth Advisory, an advantage of being independent and giving us that flexibility to help build the plan and be there over the long run to assist with that plan as life changes ultimately.
Absolutely, John. You know, when I think of it, we talk a lot about the planning aspect of that. And when you're looking for that financial advisor, you know, these aren't just investments you're sold one time or shouldn't be and just not looked at again, or having another advisor wanting to come in and resell you something else. This is a long-term retirement plan that you want to have consistency over time to carry that plan out to have the utmost chance of success at the end. Having a team of people working together consistently for that is really important. You know, then Larry eventually kind of dives into that credit and the 4 C's of banking when it comes to that. You know, it makes me think a lot about how that's changed over time, and looking ahead for maybe my children's of that credit score is so important. Now, when you get into retirement, you may be thinking, well, I don't need it so much, but there's other things that revolves around, you know, insurance pricing, all that sort of stuff. And maybe someday you may need to borrow some money. Maybe it's a line of credit to do a remodel or something like that. There's different ways to position that maybe within the retirement plan.
Yeah, so true, Art. And again, that's one where if you're building a plan towards retirement and want some help, or if you're already in retirement and may want to make some adjustments to that overall plan, we'd love to offer a no cost, no obligation second opinion and just sit down with you to learn more about your situation and how we can maybe help you plan to retire well. Stay tuned, as we're going to be diving into the financial cycle and planned giving, so stay tuned.
Are you nearing retirement or in retirement? Have you had your portfolio just looked at or have a second opinion on that portfolio recently? Centennial Wealth is a full service advisory firm, and we have multiple locations in northern Michigan. I'm in the Gaylord office primarily. The office is right downtown Gaylord. Also up in the Petoskey office as well. That office is right off of 31. I'd love to hear your story. I'd love to sit down and chat, and it's a free, no obligation consultation, so just call the number on the screen.
Will your money last as long as you do? Check out our free instant download on cen-wealth.com on the key financial challenges that can make or break your income plan in retirement. To receive this instant download, simply visit cen-wealth.com, scroll down, and click Download Now to receive your copy of Will Your Money Last as Long as You Do? Simply visit cen-wealth.com.
Many of you might not know this, but I had my own tax and accounting practice for over 25 years. I had to advise a lot of businesses over those years, and I would always refer to what I called the financial cycle. But I wanted to kind of give you an idea what that looks like today, because I think it's just as relevant when you're looking at the market as a whole. So I just want to show you kind of this relationship and when it's healthy and when it's not healthy. Okay, again, they call this the financial cycle. You know, you got what's called a profit and loss statement. That is basically your sales, the total revenue you're bringing in, minus your cost of goods sold. If you're a retailer, that's the cost of your inventory that you're selling, minus your operating expenses. You know, that's your rent, utilities, wages, all those kind of things. Well, after you take your sales minus your cost of goods sold and your expenses, you get what's called your profit. And you're hopefully hoping that's going to be more than that, right? Now, there's also a financial statement called the balance sheet, okay? That just basically shows you a snapshot of your organization as of a specific point. So it's basically your assets, everything you own, equipment, inventory, buildings, and the like. It has to equal all your debt, your liabilities, and your owner's equity, okay? That's the relationship. Your assets equals your liability plus owner's equity. Now, here's how the cycle works. Your assets help you generate your sales. So if your assets are inventory, whether it be equipment or what the like, they're going to generate your sales. Then it's going to go down through what's called what I call the noodle maker, right, to generate a profit. Now your profits can only go one of three places. They can go back up into new assets, okay? They can either go pay debt, okay, your liabilities, or they can go in owner's equities pockets to maybe then turn around and pay dividends, okay? So if this is a healthy thing, you're generating enough profits to be able to do all these three things and generate enough assets in your sales, you have a healthy cycle, okay? But any one of these things become unhealthy, you have an unhealthy cycle. So let's say that I have enough to pay my debt, and maybe I'm paying into the owners, but I don't have enough to fuel my assets, then that's going to slow down my sales, which is going to affect my bottom line. So folks, when we look at the economy and we hear things like low interest rates, okay, that's good for corporations because their ability to pay debt is good. But as soon as interest rates rise, their ability to pay all that to debt gets less and their financial cycle can be hurt. All right? Let's say growth is slowing and sales are starting to decline. That's going to lower their profits and then make this unhealthy. So just like a human being where we have organs and they all have to be in balance, the financial cycle has to be in balance. So when you're hearing things in the economy about slower growth or higher interest rates or any of those kind of things, know that there's a lot of good reason behind it. So hopefully you found this valuable, just something I thought you might want to know about. If we can be of help in any way, then please give us a call.
Hi, my name is Jack Clunner and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Hi, listen, in this segment, I want to talk to you about what we call planned giving. Okay, here's some strategies that you may or may not know of. First of all, there's what they call charitable remainder trusts. Okay, this is where you make an irrevocable transfer to a trust. Okay, and then that trust provides income to that beneficiary. And then at the end of the term, the money just goes to the charity. Now the plus in this is that you get a partial, tax deduction because you're giving to the charity, but they got to back out actuarially the income that you're going to receive. So there's a plus here, but the con is it's irrevocable, meaning once you put it in that trust and it's formed, you can't undo it. Another strategy is what they call charitable gift annuities. Okay, this is where you make a gift to the charity. Okay, the charity provides an income stream back to you for your life. Okay, and then when you die, the charity just keeps the balance. Okay, so very, very unique strategy. There's then what they call remainder interest deeds. Okay, this is where you can gift property, okay, to the charity. Now they own it now, but then what you do is you retain a life estate, which means that you can basically live in that property for the rest of your life. When you pass away, it's already in the charity's name. They keep the property. This one is really neat. It's what they call donor advised funds. Okay, this is where you can take money, put it into the fund. Okay, you get a tax deduction for whatever when you put it in. The money within that fund grows tax-free, meaning you don't have to pay tax on the growth. And then you get to pick the charities that you want the funds to go to. Very neat, and it can be multiple charities. So this is a very neat strategy. One that people miss all the time is what's called gifting appreciated stock or bonds to a charity. Think about it. Let's say you purchase the stock, your number of shares, it was $5,000. It's now grown to $10,000. If you sell all that stock, you've got a $5,000 capital gain, right? Well, what they'll allow you to do is take that $10,000 of stock, gift it directly to the charity. You get the deduction for the $10,000, but you don't have to pay tax on the capital gains. Listen, if you're somebody that's already giving to a charity and you're holding a portfolio of appreciated stock, this is absolutely one way you want to give. All right, and most charities, you'd be surprised, can receive stock and bonds that way. Folks, we make a living by what we get. We make a life by what we give. Winston Churchill. Listen, if we can help you in this kind of planning, I encourage you, give us a call.
Wow, two really informative segments there here on Retiring Well. That first one, talking about the cycle and stuff like that and how that works. There's so many different things that can relate to, but think of it from a market perspective. At the end of the day, those are the fundamentals people talk about and always wanting to look back at that. The market can be doing all these great things or bad things, but then ultimately at the end of the day, you're an investor. You're an owner in some of these companies with stocks and stuff like that, looking at where that comes into play. Then we talk about planned giving and what that looks like. Boy, it sure is exciting, and seeing people light up when they talk about giving. Most of retirees, or a lot of cases, are giving or tithing or some way of that, and seeing the joy that brings and the lives that they're changing. Boy, adding that in as a plan can even make a greater impact, not only for yourself, maybe saving a few tax dollars, but potentially even being able to give more.
Yeah, and one of those ways that you can be looking at that is maybe if you're at that age where you're taking those required minimum distributions, so now that's age 72, and so if you wanted to be giving to different charities, or if you're regularly tithing to your church, one of the ways of doing this is through a qualified charitable distribution, where you're able to take a distribution from your retirement account and have it go directly to that church or charity, and ultimately then that counts towards your required minimum distribution. And the benefit of that is then it's not a taxable distribution for you. And so again, it's a major benefit. It's called a qualified charitable distribution. I know it's something a lot of our clients are looking at with our tax planning team year in and year out. And so again, that's really important to be aware of.
Absolutely. If you've taken anything away from this show today, you've heard us talk about plan. All these different aspects encompass a really good retirement plan. We're here at Centennial Wealth Advisory are trying to strive to help you plan to retire well. When you're looking at all of your assets and how that's all going to work together, having a very well thought out holistic approach to that can be really, really beneficial for your retirement. Give us a call at the number on the screen. We'd love to sit down with you for a free, no obligations visit and walk through that. Look at all those areas that are so important to you and help you meet all the goals of your retirement. Stick with us. Coming up next week, there's going to be some more great information here on Retiring Well.